Miiflo. This is, what is Miiflo? How can it help me make investment decisions? It's kind of like a Miiflo 101. Just to get started, we want to talk about risk involved in markets. That we're going to talk a lot about risk, how to manage risk, and do that effectively. But we want to be aware of that. Just a quick introduction. My name is Josh. I'm the founder of Miiflo. Quick background on me. Have been in markets for about 13 years, as well as in a number of different industries. The similar thread of that has been taking complex ideas and helping people distill that so they could make actions. So whether that's been a nonprofit, tech, for-profit, that's been the MO. I run my own hedge fund. I'm a licensed with the National Futures Association, and have brought Miiflo as an attempt to answer a question. And the question is, where do you find your investing ideas? We are at a crossroads when it comes to how people express and orient toward equity markets in the United States. Really, it's the rise of the retail investor. If we look over the last number of years, we've seen retail investors really stepping in a large way. We've seen this before, but especially in the last number of years. And that has been driving interest. That's been driving what we've been talking about. And that is informing the types of ideas that are out there. Now, the question being, where do you find your ideas? If it's over the last couple of years, some people got ideas from a group like this, Wall Street Bets, which was a thread on Reddit, a social media platform. And they're suggesting potential ideas. Or maybe on YouTube, and you followed a guy like this. His name's Roaring Kitty. What a name, right? But this was the guy that orchestrated a short squeeze in GameStop and encouraged others to do the same. Or maybe you followed Dave Portnoy, Davey Day Trader, who was very active during the pandemic, a classic sports gambler who turned to stocks when sports were shut down. This is actually a screenshot of him pulling Scrabble tiles out of a bag to figure out what ticker he should buy. He's also coined the phrase "stocks only go up." In the era that we're in right now, a little bit different, but it explains why over the last couple of years we saw these names being those that were traded. GameStop, Bed Bath & Beyond, AMC Entertainment Holdings, rocket companies. And that's great. And it worked for some people for some bit of time. But at the end of the day, Jack Bogle's right. Jack Bogle, the founder of Vanguard, who brought to us as investors the modern ETF, has stuck a claim, and the math supports him, that whether it's a retail trader or even a hedge fund, great research just came out this week, and the research found that hedge funds are no better than retail at finding stocks that are in play. Now, what's missing from that report is that the performance for anybody who picks stocks does not work. That over the long term, as they're trying to find edge and find alpha and find yield in the markets, there's nothing that beats the benchmark, which is why these ETFs or exchange traded funds have been so popular, including the SPY, which allows you to essentially invest in all of the companies of the S&P 500 and to match what almost all investor advisors and hedge funds use as their benchmark, and that's the S&P 500. So even though you see periods of time when there are outstanding stock pickers, over the long haul, they're ineffective. And so this creates a challenge, and it keeps this question being, it's like, where do we find investing ideas that actually work? Because while stock picking doesn't work, there are effective means that we're going to talk about here. And what it requires is you to think about how you invest differently. And what do I mean by that? Let's talk about some of the prevailing ways that people think about the stock market that you have to unwind and unlearn to some degree. I've even heard them this week. One is the idea of buying and selling, that I'm looking to buy a stock at an advantageous price and then sell it at an advantageous price. I want to buy the lows and sell the highs. And all of the math is clear, is that we're not good at doing that. And especially someone who's a part-time investor or not looking at markets all the time, even worse so. right? So the idea of trying to pick bottoms and tops is a bad game. The next one, especially in the environment that we have now, where the NASDAQ is 30% down, the S&P is close to 20% down for the year, is that you'll hear this trope. I have 20 years. It doesn't matter. I've got 20 years. Where does this come from? This comes from some math that suggests that if I'm in equity markets for 10 years at least, there's 100% chance that I will see a return. So then this is used by every financial advisor, Northwest Mutual, Merrill Lynch, and so forth, to encourage people to stay in the market. They don't want those reimbursements. They want it staying in there. And they'll say, hey, I have 20 years. Now, here's the challenge. While the math is clear that over 10 years, you will get a return, the math is unclear on what is that return. It could be 0.001. That would be a return, would it not? However, is that effective towards meeting your investing goals? I asked someone who told me this last weekend and said, hey, I got 20 years, it doesn't matter. I said, okay, that's great. Yeah, and you don't have to tell me how much, but how much you have in your retirement account or in your brokerage account. Let's fast forward 20 years. If the amount that you have in your account today is the same amount that you have 20 years, is that sufficient to accomplish your investing goals? If it's not, if it is, great. If it's not, then perhaps we need to think about these investment vehicles a little bit different. Another one, I invest in this because I like this company. The story goes, hey, find companies that you like that are delivering value and invest in those type of companies. The problem is that attaching affiliation or some type of affinity to a stock and the performance does not bear out over time. So it creates a significant challenge for anyone who is trying to find consistent yield. Now, can we find periods where that works? Absolutely, we can. But over the long term, it's more of a challenge. So here are some things that we need to embrace. So if those are things that we need to unlearn, here are some things that we need to embrace to have consistent approaches in investing, especially in U.S. equities. The first one is that the only fundamental that really matters is behavior. The idea of looking at a balance sheet to predict the stock price or movement is really not effective. We'll use Tesla as a prime example. So Tesla is not a profitable company. Now, they do have profits per share in a quarter by quarter basis. It's how they were included in the S&P 500. It's why they're now put into pension funds. But Tesla has a mountain of debt. Okay, the revenue that they have is only in service of that debt. For them to justify the street value of that stock, it would require them to continue the earnings per share track that they've had over the last number of quarters, every quarter through the year 2135. They are extremely overvalued relative to the fundamental accountings of that company. So looking at a price to earnings ratio or trying to look at financial sheets and predict where the stock's going to go or what's a reasonable price target, this is not it's not something that we have to worry about. What is effective is behavior. So how participants are positioned around an underlying stock is far more predictive in where the stock will go than anything else. If we go back and look at the GameStops and the AMCs and those prices went higher, part of the reason that they went higher is because of, well, not part, the only reason they went higher is it had nothing to do with the fundamental values of those companies. They were all bad. The reason it went higher is because there were hedge funds who had bet on the fundamentals and were going lower and had taken a short position, meaning that they would lose money if the stock price appreciated. And they had such a large position that they had a larger position than there were typical average shares traded in a day. So if I have 30 million shares of exposure to a stock that trades $1 million or million shares a day, it would take me 30 days to get out of that position. If I bought all of the share, if I was the only buyer all day, it would take me 30 days. We call this days to cover. Okay. When you're buying everything that comes out there and you're exhausting that supply of available sellers, that moves the market higher. And the mechanics were we had all of these retail traders buying call options that are then forcing dealers to go and hedge that risk by buying shares, which increases the upside pressure and makes the price go higher. Has nothing to do with the fundamentals at all. The only fundamental was human behavior. So if we can find human behavior at play, that we can lean on. The next one is that the tail wags the dog. Now, I alluded to it a little bit here in the GameStop AMC idea, is that the derivatives, so options, actually drive where price goes. The whole world hedges their risk in the S&P 500 complex, their equity risk in that, because it's the most liquid, meaning there's the most buyers and sellers available. It has the most types of ways to construct hedges against portfolio risk. And because it represents the 500 mega cap companies, then that's the significant risk that most equity funds will have. What the stocks can do is driven by what participants are doing outside of the stock itself and actually in the underlying vehicles. Or let's imagine that I'm a founder of a company that has a listed stock, and I hear or know that there's news coming out that's very favorable to the stock or will provoke an emotional or human behavior reaction. It's very positive for the stock. I can't go and buy a whole bunch of shares. Everybody would see it. So instead, what they'll do is they'll go and they'll establish that position in options, which is a derivative of that underlying vehicle, in a way to hide their size. But those types of trades influence what happens in the underlying vehicle, because the only fundamental is behavior. Now, the next way that we need to think about it is thinking about insurance companies. So, let's imagine that, it could be any insurance company, but a property, casualty, auto. How do insurance companies make money? Because people still have car accidents. People have fires. There are natural disasters. How is it that insurance companies are profitable? Okay. The reason that they're profitable is because they have these really super smart guys who go out there and run the math on the probabilities that those events will occur. And then they build in the premium that's in excess of the potential unfavorable outcomes. And because they do that in excess of those potential outcomes, when they don't have those outcomes, what is it but a windfall to the insurance company? So because are there spots where they take on too much? Yeah. And then that's when they fight to, prevent how much they pay out in claims, right? Because they know they have so much premium that they've priced in. But we can use the same approach to markets to be profitable over a consistent long period of time, just like an insurance company. And the way that we do that is we use option contracts. So an option contract is to a stock what an insurance policy is to property and casualty, property within respect to natural disasters or accidents. So we can actually construct trades using these vehicles that operate the same way. So if you can think about, hey, I know how insurance companies work, then I can construct trades that will allow me to profit over the long haul, just like an insurance company with the same degree of predictability. Another way that we have to think differently is we have to think about the exit before the entry. So it's long been known within the financial industry that there's basically two camps that people are placed in. There's what's called retail. That's most of us. If you go and open a brokerage account as an individual, that's a retail investor. And then there's institutions. Now, it's often known that retail loses money. Institutions do not. Retail, there's all these rules like the rule of 390s, that 90% of retail lose 90% of the value of their account within 90 days. Or that if we look at retail traders just on, for example, the Robinhood platform from November of 2019 to June of 2021, collectively lost about $5 billion in assets through that period of time because they don't have skill. Institutions, however, over the same period of time are very profitable. And part of the reason that they're profitable is because they know the exit before the entry. So they don't ever place a trade, never initiate an investment without knowing where they might exit, because then that allows them to discern what the risk should be. I can't tell you how many conversations I've had over the years with investors, and I do a portfolio review, and I look at the portfolio, and what do I find? I find stocks underwater or investment ideas underwater. And then I ask them, hey, well, that's great. Well, it's not great that they're underwater, but the question is when you originally entered this, where did you intend to get out? And I get this blank stare, like, I don't know where I was intending to get out. That is a key difference between a retail investor and an institutional investor. When I was running a managed desk on the institutional side within the futures industry, if I was placing a trade and I did not know where the offset or the exit was before I placed the trade, that would put me in timeout at a bare minimum. If I did that too much, that could get me fired. Okay, so institutional insight always thinks about the offset first, doesn't think about, and then looks at the entry with respect to that. Retail, one of the reasons that retail continues to fail is that they're triggered into an opportunity that's undefined. So then they don't know how to define the risk. And then what happens is the brain, very predictably, when the opportunity goes against you, starts to fight that because nobody wants to be wrong. And so then we will lose money to prevent from being wrong, and will lose it significantly to the point that most investors, especially if you're a 43 to 63-year-old white male, will lose most of your investments and assets after you've already lost 50% of the value is when you will then capitulate and sell. It's a pretty predictable phenomenon. So knowing that behavior is the only fundamental, knowing that the tail wags the dog, knowing that insurance companies are profitable, and knowing the exit before the entry allows us to get in a posture where we're not just letting the institutions have all the fun. So, for as long as there have been markets, the institutions, when I talk about institutions, the well-known names are firms like JP Morgan, Goldman Sachs, Morgan Stanley, BlackRock have had edge and retail doesn't. It's not that they're significantly more intelligent than you. They're not. They just have different tools. They have different training. And so our belief is that if we gave you the same tools, you would do just as well. And that's what Miiflo does. It gives you access to the same types of ideas that institutions would look at, the same types of stocks that institutions look at, and expressing the risk in the same way. Now, how this works is that you're basically letting the machines do the work for you, because there are 4,000 US listed stocks, 4,000 plus. And then that ebbs and flows based on initial public offerings, but there's about 4,000 at any given time. How does anybody have time to figure out which ones you should invest in? And knowing that if I try to invest in that, I'm not going to win over the long haul. The math is very, very clear on this. You can't pick stocks and win over the long haul. So then, what do I do? Well, the way that we express that is with these options, and specifically something called an option strategy, which is a way of buying and selling different option contracts to construct a window of probability around a stock. And historically, there have been, around 20 or so vetted classic option strategies that are well known in the industry. In fact, the Chicago Board Option Exchange just reopened what we call open outcry trading to facilitate the execution of these orders, because this is what institutions trade, and they needed a vehicle to be able to do that. The challenge has been, well, okay, these are great strategies. The probability curves are known on them. Just to give you an idea, one of these strategies is called a strangle. So, and we're going to look at a strangle here in just a second, but it's a way of kind of strangling the market. You're putting your arms around an underlying product within a range of price. So you don't have to think long or short anymore. You can think about ranges. You can benefit if a stock goes nowhere. It doesn't have to go higher or low. It doesn't have to just higher only. They can go lower and you can benefit. They can go sideways and you can benefit. They can go sideways and higher and you can benefit. These strategies are well known. The challenge has always been, if there's 4,000 stocks, how do I know which strategy to apply to which stock in which time? And that is exactly what Miiflo does. It looks at these 4,000 stocks and it says, hey, these are the stocks that are what we call in play, meaning they're of high interest to institutions. And these stocks are the best candidate for this specific strategy at this time, doing all of the homework for you. And what the result is it gives you daily drips. So these drips, these ideas are ordered in such a way, and you don't have to have a fancy finance degree, but it orders them in such a way that you can begin thinking like an institution. So it starts with the opportunity. What's the price target? What's the reason, the rationale for why we believe this idea has validity? And then right behind that, what's the risk? How much do we stand to lose? Because no idea is guaranteed. But what is interesting is that we're adding a probability to these that can increase our opportunity for success. When I buy a stock or, and enter the stock, it's a 50-50 bet at best. If I'm just looking directionally on a number of these strategies, I will know when I place the trade, the probability of success. And many of them are 60 to 70% plus. This is very, very actionable and very, very helpful in being consistent. And then the third component to that, and this is just institutional thinking, is that, okay, once I place this trade, how will I know that the idea is working? Because every investor is a storyteller. When we place an investment, we're buying into a story. And we have an idea of how that story should go. And for us to stay in that investment to get the maximum potential out of it, we need to know how to know that we're right. Okay. And all of the drips do exactly that. And then finally, how to know that we're not right. And that is most important, because the brain will do everything it can to convince us that we're right. And if something goes against us, then we will start looking for any bit of information we can find to affirm, yep, you made the right call and it's going to turn around. You made the right call and it's going to turn around. I remember one of my largest equity losses that I ever had was in a company called Viringo, VRNG. It was a company of 11 employees, 1 CEO and 10 attorneys. They existed solely to buy patents and then sue companies that they believed were in violation of those. They actually sued Google and won, and the stock went to zero because Google had way better attorneys and they could litigate it to the point that Viringo would never get paid and they had no significant revenue, and the stock went to zero, as it should be. But I was going out when I had, I had 10,000 shares of Viringo, and I was going out on Twitter. I was going anywhere I could to find something that affirmed, yes, hold on to Viringo, hold on to Viringo. And I didn't lose it at zero, but I did take a substantial loss on that trade. And, I went looking for it later and it lost so much that it was delisted from the exchange. But I remember like sweating at night, and anything I could grab onto that told me I was right and I should stay in the trade, until finally it was so painful I got out of it. What we know about how the brain makes decisions is that, one, if we're going to be successful long-term as an investor, it's almost more important to know that you're wrong than it is to know that you're right. Because if I know that I'm wrong, I can get out of the trade and I can redeploy that capital. And because Miiflo is going to continue to offer to you probabilistic ideas, if one doesn't work, that's great. There's going to be another idea. It's not like you have to wait for Roaring Kitty and Wall Street Bets and Dave Portnoy to come up with a new idea, or Jim Cramer or whoever else that you might follow to find ideas. It's going to generate ideas that have all of these 4 components every day, and multiple ideas for you to be able to select from. So that being said, let's look at one historically and see how that constructed and see how that played out. And then look at some ideas that were generated for tomorrow. And we're going to construct those and actually place some of those orders to be ready to go tomorrow, so that we can see if they can get filled. Because one of the beautiful things about this is you don't have to spend a lot of time. Ideally, you're spending 15 to 30 minutes maximum a day looking at the drips, finding the ones that you want to act on, placing an order, and then letting it go. So this was one that came out a while ago, and it was Paramount. So Paramount Global, that owns CBS, film company. What's awesome about these drips is that you are given the stocks that are what are called in play. So of those 4,000 stocks, you'll find names that will come up and then they will evaporate, because there's in the human behavior component, that fundamental, people rush into a stock, it becomes in play for a little bit, and then it evaporates. Now, there are some that are consistent day in and day out, but there are others where there's some significant interest really quickly that then goes away. Trying to find those is very difficult. Miiflo finds them for you. So here was the idea. I said, hey, Paramount, says, what's the opportunity? Okay, so it says Paramount is lacking direction and likely to continue to lack direction over the next several weeks, with implied volatility rank at 66 0.40%, it's a good candidate to sell options and collect premium over the next 20 days. Now, if you've never seen or heard this type of language, that's going to sound Greek or alien to you. And that's okay. Let me walk you through it and know that, part of the reason that we spell this out is because we don't expect you to know all this stuff. This would take, for some people, decades to understand the mechanics. We're just going to spell it out every time. So you don't have to remember. It'll just tell you about that. But the idea is here, it's lacking direction. Now that's interesting, right? Because it's not going anywhere. All stocks are either moving higher or going sideways, or moving lower or going sideways, right? There's really just kind of moving directionally or moving sideways. So if you have a stock or you have a large market that's moving sideways, one way to look at that is to say, I have nothing to do. But that's opportunity cost, when there are ways that we construct trades around that. So this is telling us the specific strategy is something called a strangle or an iron condor. So for a strangle, the idea is to look for options that expire as close to 45 days in the future as possible. So what I've done is I'm going to pull up a platform. This is a Thinkorswim from TD Ameritrade, which is one of the brokers that you can place these types of trades on. And I've got Para, and I'm actually back here on the day that this idea came out, which is the 19th of May, 2022. And it says to go look out, 43 days in the future. All right, 45 days in the future. And then we're going to sell a call option at a strike price that's 30 deltas above 31.55 and sell one 30 deltas below. Now, what is a delta? It sounds Greek to me. It's because it is Greek. Essentially what it is, and that you can see the delta column right here, and there are numbers. This is the probability that we will be at that price in however many days. So we're looking at the July 43. So there's 43 days left in that contract. These are different expirations of options. On the right side are puts, and on the left side are calls. The delta is the probability that we would be trading at, right here, 32 deltas. So the probability we'll be trading at 30 when the stock is trading 32.22 was the last. This was, the day after that idea, is just 30%. The probability that we'll be trading at 35 is about 34%. So if I combine those two deltas, I get a 64% probability that I'm going to be trading between 30 and 35 over the next 43 days. That's what that market has actually priced in to the potential range of that stock. And the back up here, when we talk about the implied volatility rank. So this is, if you think about each stock as a person, it has a different personality. This is the implied volatility is the amount of movement that an underlying stock will make over time. And then if we take that relative to itself over a year, we can get a sense for, how volatile is the stock at this moment in time. And when it's above 50%, we can construct trades where we're actually, this is basically saying, hey, we're at higher risk for the hurricane. So we have an opportunity to price our insurance higher. And then guess what? If the hurricane doesn't come, we can just collect that premium. And that's exactly what the strangle does. So what we do, going back to the platform, is that we go and we sell this 30 call or 30 put, and then we sell the 36 call, and that creates together one trade, and it's a $2.15 credit. Now, because every option controls 100 shares, that means that we would net $215.50 in credit. What that is that's the maximum, potential profit that we could get for that trade. Now, here's how that works. As we, and it explains. So what's the risk? So it's what's called an undefined risk trade, meaning, as described here, if Para trades above 36 or below 27.76, we'll look to potentially close the trade for either a small loss or break even. So this trade works because we stay between prices. If we get outside of these expected prices that Miiflo talks about, then that trade will start to go against us. So it tells us, hey, this trade is going to likely work for you as long as you stay within this range. And because of the conditions within the stock, it's highly likely, but it's not a guarantee. So if we get outside of these prices, we need to likely exit the trade. And if that's the case, most likely it's going to be at break even or a little bit of a loss. But if we hit one of those, we get out. Now, how will we know that we're right? Is that we're going to continue to trade in that range. So often when we place these trades, we can just have alerts. So if you find a platform or a way to know which prices for each one is the risk. And as long as it doesn't hit those, you can check it every day at the end of the day. You can go, hey, every day I made money. Every day that we go forward is one less day that we could have a hurricane, meaning more premium I can collect. And then how will we know that we're wrong? Well, if we trade outside of that range, then we're likely wrong and we would need to exit the trade. Okay. So if we go back here and look at this, we're going to actually go back and look historically. So it was a $2.15 credit on the 9th. We're going to go forward in time and look at what does this look like over time. So I can actually pull up a graph to get an idea, and we can go forward. So watch here, the P&L open on the 19th was 0. But as we move forward in time, so we go to the 20th, now it's $4.50. We go to the 21st, the 22nd, the 23rd, now it's $28 of P&L. Now the 24th is 13, 25th, 26th, now $44, meaning that we have enough of, 44 cents of that $2.15 has now collapsed. And we can actually buy it back now on the 27th. So just, not even 10 days later, $54 in profit. A couple more days to the 30th over the weekend. Now it's $71 in profits. We're getting close to half of that P&L. The first $76, then $69, $59. And then that is, if you see it going down, that means that we're likely starting to hit the prices that would make that trade invalidated. But even if we go in time, see, we're now to the 7th. Today, it's at $80. Okay. The 9th, it's at $9. So that would suggest, again, that we've approached one of those, the edges, and that will, but as long as we're in the middle of that and smack dab the most. So when we were at 80 cents, we'd almost captured half of that. We could buy that back. So, at $2.15 of potential profit, I believe I covered it, when I was up 75 cents. So I got $75 out of that $2, but to put that trade on, cost me about $400 in what we'd call margin or capital required. So $70 versus 400 is a pretty significant return on capital, and a very effective one that has a probability to it where I know where the edge is. So this is how we can think about constructing trades. So what we want to do now is we want to look at some additional examples. So I'm actually going to pull up Miiflo, which right now we're in beta. We're about to launch an app here at the end of the summer that will add a whole new host of ideas that we couldn't wait to get the technology out in front of you. So here are drips for tomorrow, June 10th, 2022. And I can sort these by strategies. So whatever name is up here, these are the strategies that these strangles are available. And we can go look at any one of them. So let's go look at another strangle. So we're going to look at one that's just like what we just saw in Para, but let's look at like Salesforce, for example. Okay, so it's a Salesforce looking for a strangle. It says, hey, we've got one here that's 51%. Actually, let's go back and look and see, since we got a couple of them. If Western Digital has got a higher, that's a 58%. So let's go with that one because it's a bigger potential premium that could be available there. So let's go and pull up the platform, and we're going to go look at Western Digital. Okay. The last price is $56.58. So on a strangle, which we're trying to strangle that market, here's what we're looking at. So if we go and look at a probability analysis, we'll look at WDC. And this is not required for you to be able to take advantage of Miiflo, but this just illustrates the idea. So this is what we call a probability cone. And these are at certain expirations in time, the expected range of the product. So if you knew this or not, but you could start at the beginning of the year and project with a high degree of certainty the probabilistic range of any product by the close of the next year. For example, at the close today, I believe that the S&P 500, is trading, around 4080. The implied low of 2022 was 3900. We knew that on December 31st. We're halfway through the year, and we're near a price that we knew back then, based purely on what the probability cone was in the options. Options are awesome because they are showing us what all these actuaries are doing and allow us to construct probabilistic trades. But look, Western Digital. So we're going to same deal. We're going to go out 45 days ideally. And there's different expirations. Typically, we want to find one that's like a monthly. So we could do the 36. We could just look at this and price it out. We'll try this one because it'll have a decent amount of volume, but we're going to look at 30 deltas. So there's a 56.58 was the last traded price. So there's this one that's a 28 delta because we don't have one that's actually 30. So that's the 52.50 put. And then we're going to go and find a call, which is the 62.50 put or 62.50 call. We're going to sell those. We're selling those two options. And that is going to give us a credit of $2.64, meaning that the max potential profit is $264. Now, let's see how much it would cost to place this trade. Now, it is going to require, it's not going to give us the buy power because the market is closed. Let's do this on a different platform so that we can get an idea of what this will look like. We're going to pull up Tastyworks. And we're going to look to trade. So we're going to go out here 36 days. So similar, different platform, but similar mechanics. So here we're going to sell this one. We're going to sell this one. Well, we're going to try to sell that one. I don't know why that's not allowing us to sell. Interesting. Clear. Try a different expiration, see if there's something. 53. Huh. Why is that not allowing? Oh, here we go. Here's the reason. We need to do a custom. We need to do a short strangle. Now it'll allow us to do it. All right, great. Let's go back. So we're going to do a short strangle. We'll go back to that 36. Now it'll allow us to do this. So 27 delta. Oh, there must be no volume in that one. So scratch that. 43. 26. Why are you not letting me put this on? Short strangle. We'll just have to drag them. So that one. Okay. So if we go 43 days out, $3.40 credit. We review this. So this is going to require $773 for a max potential profit of $3.40. So just looking at the calculator, right? We can go and say, oh, well, if I got the full credit divided by 3, that's a potential 43% return on capital. The 20-year return for the S&P 500 is 10%. This would make 43% on just that $773 in about 20 days. Now, that's if we get the whole thing. More likely we get half of that, right? But still, if I take 340 divided by 2, that's 170. I divide that by 773. That gives me a 21% probability. And there's an 80% probability because of the deltas that I will see that profit within about 21 days. I can actually make this cheaper. And Miiflo talks about that by looking at, it says I can make it, as an alternative, I can make an iron condor. And what this does is this reduces the capital required. Now, it's going to reduce the amount of potential profit, but it will reduce the capital required. So what I can do is I can go out and I can buy a put beyond, and I can buy. I'm going to turn this into a buy. And a buy, and see now it's made it $59 is the credit. However, look at how much it requires me to put this on. So I could make $59 and it's going to require $45. So this is the maximum that I can lose now. The max loss is that, $41 plus some fees is a way to get this very tight. And this is important. And this is a reason that we built this into Miiflo, is because when we look at FINRA data, especially of Robinhood, which has 22 million active daily logins, half of those accounts have $2,500 or less in them. So we need ideas that are affordable. So these are probabilistic ideas that are affordable and historically have been out of reach. Talked about that these have been known for quite some time. The challenge is that the fees associated with them make them cost prohibitive. But with zero commissions, you can trade these as if you were an institution sitting on the exchange. One of the benefits of being an institution is that you can place these trades on the exchange with no fees. That's why they do these types of trades. We now can do these as retail investors and leverage the reduced fee structure. So with that trade, I can go here now and I can say, all right, I'm going to go back to edit the order. So right now, and you can see that there's a spread here between 4 cents and $1.15. That's because I've got all of these contracts going. It's going to have to kind of work all of these from an order standpoint to fill my order. But I'm going to place this order, and I want to get paid a little bit more. So I'm actually going to make this a little bit richer. So I'm going to make it 65 cents. And I'm going to have that working. So it's going to require $40. Isn't that amazing? Send that order, and that's now working. And so if I can get, filled at 65 cents, then that order will be in play and it's ready to go. And if it doesn't fill tomorrow, then that order will cancel and I don't have anything to do. Let's look at another one. Okay. The whole point is to be able to have ideas. And what's great is that if there's specific strategies that you really like, then you can just hone in on those specific strategies. So if you're like, hey, I just really like strangles. I just want strangle candidates. Well, Miiflo gave you 2 strangle candidates today, or one that I also like, it's called a double diagonal. Okay. So we're going to look at one of those. We'll get one of those in Target. Okay. So this is where we have a stock that's been trading sideways for some time, and now we're expecting it to make a move, but it's expecting too much of a move. And so we're going to try to finance and get ready for a position of that move, and look at arbitraging. Sorry for the significant language there, but arbitraging between different expirations. So we're what's called selling a straddle and buying a straddle. So if you don't know which way a stock is going to go, one of the strategies is called straddling the market. So you're basically, it's like, imagine that you're on a horse, on a saddle, and you're straddling it, ready to go either direction. You can go higher or lower. It doesn't matter. The idea is that one side is going to lose, but the one that wins will win bigger than the one that loses. But until that happens, and to finance getting into that position, because that probability cone kind of constrains those movements, we can do what's called a double diagonal. So we're going to look at a double diagonal in Target. Okay, we'll look on Thinkorswim on this one as well. So we'll go to Target, or on the trade tab. Let me just delete this. So how this works is we're going to go out about 15 days and we're going to sell. Well, actually, let's go out 36 days, and we're going to buy a straddle because I want to show you what a straddle looks like. So we closed at 154. So we'll do the 155. A 155 straddle. Okay, so we're going to analyze this trade. Get over here to the risk profile. So this is what this trade looks like. So here's what I mean. Like we can go either direction. I've bought a call and I've bought a put. Now, as long as I move in either direction, this trade can make an infinite amount. Now, but to put the trade on, it cost me $13.10. That's pretty expensive. That's $1,310 to put that on. That is also the max that I can lose. However, because it's priced in what those moves are, the only way that I could really get paid is if we move swiftly. Most likely we won't. So I need to get the cost of this trade cheaper. And the way that I do that is with a double diagonal. So I've got one leg. What I'm going to do is I'm going to go about 15 days out. And we've got the 155. I'm now going to sell. And now notice that it took that $13.10 and made it $4.40. So now instead of $1,310 to put the trade on, it only cost me $440. Here's the other beauty of that. If we now go and analyze this trade, and we'll get rid of just the strangle, the probability curve and the P&L curve looks very different. So essentially, here's a window. This is all P&L. So this is the zero line of profitability. If I stay between 147 and 163 or the next number of days, this trade's actually going to make money. In fact, if I go forward in time, you're going to, down here. If I go forward in time, you'll see this purple line moving higher. That's the current P&L. The blue one is the P&L at expiration. So on this trade, $400 to put on. If I'm at 155 on, and I can give you the exact date, if we go forward here, about 15 days, if I'm at that price, I'll make $500. So more than 100% return on capital. And the stock didn't go anywhere at all. And I can exit both of these positions and close the trade and be done and benefit from that trade. Super amazing way to think about how to approach this. So it's financing this long straddle by selling a short straddle, which makes it very, very affordable for trade. So look, $442 is how much that trade requires put on. Very, very affordable inside of an account that has $2,500 or so per the FINRA information. Okay, let's look at another one. Actually, I want to place that one. So I'm gonna same deal. Now, what on this one I want to get, because I'm going to buy it as a debit, I'm going to sell it as a credit. So I'm just going to make it a little bit cheaper. Let's make it $425. Confirm and send. And that trade is now working. Okay. If I get filled at $425, I made the price come to me a little bit, then I will then eventually, I buy it as a debit. I'll sell it as a credit. Miiflo explains that you're going to buy it as a debit right here. And then you'll eventually sell it as a credit. Okay. Let's look at one more here and then we'll be done. Out of the money put credit spread. Cool. Zendesk. Let's look at this one. So here we've seen a different orientation. So Zendesk has seen significant lower prices. It's below all the recent value references, and value to a market behaviorally is where there have been transactions at price. So it's not a evaluation like on a financial statement, but it's the amount of inventory. Think like a housing market. Okay. So the stock is what we call in the move phase. We talked about stocks are either moving or going sideways. In the next phase is going to rest. It's going to go sideways. So it would be great if we built a trade that would benefit if we went sideways or higher, because it's already been going down for quite some time. We know the next thing is it's likely to go sideways. So this is a trade that benefits if we go sideways or higher. Either one of those works. And even if we go lower, but not lower fast enough, it still works. So this is what we call an out of the money put credit spread. So we're going to sell one put and buy one put at the same time at a lower strike price. So we're going to go out, looking at Zendesk here. Notice I haven't looked at a chart. Everybody's obsessed with charts. We don't need them. Okay, so I'm going to go out here. We can go 43 days out. And what's the last price? 69. We do not have any other lower strikes there. I guess not in those weeklies. So let's go. Yeah, we'll just do the 36 days. So we're going to look for a 30 delta at least. So that's the short one. So that's 60. Last was 69 was the last price. So 69, 60. And then we're going to buy one out of that creates a credit. So this is $1.10. That's the most that we can receive. Okay. The short one, the near one is a 24 delta. It's 24% probability. In 36 days, we'll be trading at 60. So we have a 66% probability of success on this trade. Let's look at the price here. For that $1.10, it's going to cost us $391, or let's make it $400. So essentially a 20% return on capital, which is exceptional, especially when we think about the probability. If we go look at the actual trade, we'll analyze this and look at the curve. So the 110 is the most that I can make. We're trading, we see 69, we're right here. This is where we last closed. So you'll notice that if we move below that, obviously the trade will lose down to the max loss, which is down here. And this is the probability, or the P&L curve. But as we advance each day, notice that curve and where that break even is actually goes lower. So that as long as we're above 58.95 in 36 days, we will make money. And if we're above $60 in 36 days, we'll get the maximum credit. We'll get the full credit. So if I'm I place this trade tomorrow, I mean, unless we go down below 63, $64, I got nothing to do at all. I can have an alert and know if I get down here, then I probably want to exit the trade. But because of the probabilities, even if I lose on this one, I can make it back. And if they don't go there right away, if it takes some time, see how this moves in my favor on into expiration. So I'm going to do this one as well. I'm going to place this trade. I'm going to make the premium just a little bit richer. Make it $1.25. Okay. So that's $1.25 on 376. And that one's now working. So I just, a couple different ideas, looked at those, scoped those trades out, placed them, and I've got some great ideas for tomorrow, and not even all of the ideas that I could use. So, one of the things that's great about Miiflo is it's giving you plenty of ideas to look at every day. If we show all of them, I mean, there's plenty of ideas that you can use, and then you can order them by the specific strategy. So if you find a strategy that you like, that's great. I mean, we are actually endeavoring to be like the Tinder of stock investing. So if you're like, hey, I like Tallman. Okay, great. I like blondes. Okay, great. You can only look at those ideas and be able to see that, so that the only types of ideas, if you just like double diagonals, that's awesome. You can set it up so that you only look at the double diagonals and filter the ideas, knowing, and after, while they're complex, after you've seen a couple of these, you'll have them down. And you'll feel the mechanics around them, and you can rock and roll and have a load of fun. So with all that being said, where do we go from here? So we start simply and build your flow. With these strategies that we have here, I mean, hone in on one strategy, read the ideas, practice them. A lot of these brokerage accounts allow you ways to, practice them and get a feel for them before you put live money on. Although, because we have the built-in risk management in there, you're welcome to start trading those, knowing where you're wrong, right? Which is so key. What do you need to start flowing? A couple things. One, at least $500 in an account. Not going to put all of that to work. If you have $500 in the account, you're going to, like that one iron condor that we did, you're probably going to have one of those until that trade's done. You need to have some backup capital in case the one that you put on doesn't work out. We don't know. It's like if you try to jump, you got to bend your knees first. Okay. So $500, you need level 3 options approval. And if you sign up for Miiflo, we start walking you through how to approach a brokerage to get level 3 options approval. There's different levels, but to execute Miiflo ideas, you need level 3 options approval. It's going to require 15 to 30 minutes of your day. Tops. And, and if you've got an idea working, you don't want to look for a new one, it's 0 amount of your day. There's no fancy financial degrees required. And you can stop watching financial news forever. It's just noise. You can just look at those ideas. Which brokerage you use, Miiflo pairs well with the brokerage of your choice. There are a lot of great brokerages out there. Robinhood, Webull, are some of the new retail brokerages, but the old standards, Fidelity, E-Trade, TD Ameritrade, Tastyworks are all excellent. And the market pressure to get their fees lower is continuing, which means that they're all candidates to be able to express these ideas. Miiflo is also getting smarter. Like we talked about, we're in beta right now. We're a web app. We will be an iOS and Android app that will include notation on your ideas, as well as it will actually notify you when a trade is at risk. So not only will allow you to, filter the ideas based on the strategies that you find favorable, but it will also tell you once you place the trade. And if you say, hey, I took that trade, then it will tell you, hey, you need to do something. So notify you and actually, do some of the thinking for you. So if you're not already on the platform, you can start with a free 7-day trial and get a look at all of the drips, or just to get on our email address, we'll get, one drip a week, and just to be able to see how these ideas are different and see how you can think differently about investing, so that the end goal is that your equity curve always looks like this, right? That we don't lose the opportunity cost of bear markets, although they're, seldom, but we don't know that they're going to be seldom. We've experienced them as seldom, but when we're talking about what happens in the future, there's unknowns there. So approaching it like institutions who are built around thinking about unknowns will help us as retail traders and investors be consistent over the long haul and reach our goals. So, hey, thanks so much for joining us for this event. I hope it's been helpful and give you an idea for how to use Miiflo to make decisions and get ideas. And looking forward to have you be part of the Miiflo community. Have a fantastic evening, and we'll talk to you soon.